Good time to welcome our market master for the day. Devina Mehra joins in. Devina, good morning. We've seen a decline from the top. You've been, speaking about how valuations were on the extreme. Earnings didn't come by. There was a fear of missing out when it came to some of these hype stocks, some of the IPOs, etc. as well. With the decline that we've seen already, do you think, some sense of normalcy is coming by, or do you see some more?
Actually, I never said that the market is overstretched or that earnings won't come through. So I think you're mixing me up with someone else. So I had always said that whatever is your equity allocation, remain invested. And actually, if you look at sector by sector, the PE multiples, even if you look at crude measure like that, are not at extreme ends. In many cases, they are even lower than the average for the last decade or so. So it's not been very stretched valuation. On earnings, my stance had been that in the second quarter, you would see an uptick. So, if I go back a quarter, that's what I was saying, because the consumption had been ticking up, and most important, inflation had come down. In some cases, even food product prices had come down, which created room in the householder basket to buy other things. So there were several positives. And GST, while overall is changes, that was overall a positive, but because of that, there was a disruption in the second quarter, in the July to September quarter. So once that was announced, my stance became that the earnings improvement you will see only in the third quarter because of the GST, right from FMCG to autos. It took some time for people to sort out what happens to pipeline inventory with the retailers, with dealers and so on. And also some consumers postponed purchases. So some of that improvement in earnings got pushed, but it is there. And now also I would say that, my stance remains unchanged. Don't put 100% in equity ever. Whatever is your equity allocation, I don't see the risk of a huge crash that you should sit out of the market. So that is very much still my stance. And
but now that we've gotten that dip, Devina,
we can discuss the IPO separately.
We'll discuss the IPOs in a bit. But just as your stance is unchanged, the market is off the highs. Do you believe that increase in allocation is important right now, as against going 100%? Maybe if you were, say, 50-60%, this dip must be bought. If yes, then how would you distribute that allocation across sectors?
It is not much of a dip from the top. If you look at it, it's just that the market is, not decisively taken out its all-time high. That's a different matter. But as I said, never have 100% in equity, because equity returns are never predictable for 6 months, even 2 years. So equity, you should have only what you can forget about for the next 8-10 years. So if you think you will need to withdraw something next year, then equity is not the place to be. Yeah. And if I go back to my February interviews, because I did a number of interviews when my book came out, and all of them I'm saying the same thing, that if you were waiting for a correction to buy, have you bought? And February we ended at 22,100 for the Nifty. So it's you know how much it's up since then. Of course, market as a whole, it has been, while the market move has become a bit wider than what it was extremely narrow up to August end, where you had only 10% of the stocks outperforming the index, but now it's a little broader. At that time, it was something like 40% of the stocks were down more than 25%. Now that's 20%. But still, the advanced decline ratio keeps varying day to day. It's still not great, but it has been improving from where it was. So market was extremely narrow till a couple of months ago.
No, absolutely. And Devina, your stance on asset allocation and being very well hedged, diversified, not just across asset classes, across global markets as well, that we know very, very well, absolutely. But I guess, for the equity market, about a month back, it was all guns blazing. We were supposed to get a deal with the US. We were supposed to get the FPIs back, and we were supposed to get earnings. Out of these three, I think two things are still iffy right now: the FPIs and the deal. Earnings, maybe we're kind of okay. But, more on that later. Let's talk about the hot subject in the room, and that's this red-hot IPO market. So, raging debate. I'm sure you've seen it on social media, maybe participated once in a while. And the thing is that the investment bankers are able to sell the issues. They're getting the anchor investors. Lenskat's anchor book was oversubscribed, and well oversubscribed, actually. The overall issue was oversubscribed some 26 times, 27 times. So then who's to say when money does the talking? But just give us your sense if you've studied any of these companies. It's not a buy or sell recommendation or avoid or subscribe, but just generally, I mean, which are the companies and the business models that you're a little more optimistic on and where pricing seems at least a little sensible, if not cheap?
Actually, I wrote a column on that yesterday in Mint.
Okay.
So, yesterday's column on Mint was that whether you should go by the big names who have supposedly invested in an IPO or a stock to take it as the good housekeeping seal of approval. And the answer is no. I mean, if you look at the venture capitalists, for instance, they often buy at a fraction of the IPO price. Many times, in fact, most times the IPO is priced at 2, 3, 4 times. The last fundraise in Lenskart times, I think, in case it is 8 times. So, and many times now IPOs have a considerable portion of offer for sale. So all those big names are getting out at the price that you're getting in. The anchor investors is another story. They are obviously buying at the same price that you are buying at the same time. But so why are they there? And I've been an investment banker and I know this firsthand. So the public part of the IPO is the allotment is a lottery. But for the anchor investors, as also for the qualified institutional placements, the QIPs, the investment banker has the discretion how much to allot. So if you look at it, there's you gave the example of Lenskart. So there like all the who's who of the fund industry are there, but how much are they investing? They're investing, 0.01 or in some cases 0.000 something of their AUM equity assets under management. So why are they?
But Devina, at the quoted price, I mean, I get it. It's probably pocket change for a lot of these large guys like Fidelity, but at that price.
So why are they doing it? So I've been an investment banker, as I said, so I know the story from the inside. So when it is a coveted issue, the funds will chase you and there'll be recriminations. Why didn't you allot me more?
Devina, just hang on. Sorry to interrupt, but we're just dipping in back to GLS. There you see the SEBI chairman walking in. He's going to be on the stage very, very soon. Shireen accompanying him as he makes his way to the stage. And so many questions for the SEBI chief, including what the finance minister said just yesterday, remember, at the SBI conclave, at the SBI event, where the finance minister did say that we're not looking to shut down the F&O market, so to speak. She was speaking in a broader context, but I'm very sure that question is going to go to Mr. Pandey on the public forum even today as to what is the regulator thinking about futures and options, which is a separate debate altogether. But Devina, coming back to the investment bankers and how they get people to write the checks for some of these issues that are priced at 200 times PE.
Yeah, so the point is this, that if you are not in the good books of the investment banker, you will not get allocation in a issue where you want to get allocation. So the investment banker can very easily arm twist you to kind of lend your name to an issue which you may not like. If you'd like the issue, probably you would have put in more. But you want to lend the name so that it gives credibility as far as the retail investor is concerned. And there is a quick...
Devina is revealing the dark secrets of the financial markets today, huh? We're treading on ice, so to speak. But anyway, I thank you for the candor. But just getting back to the recent issues, a lot of them are very well-known businesses, touch and feel businesses, which we as consumers know, whether it's Grow, whether it's Lenskart, whether it's PhysicsWallah. What do you think of the quality of the business and the pricing?
So I have not studied all the issues, but broadly, when there is frenzy in the IPO market, it mostly does not make sense for the retail investors to get in because most issues tend to be overpriced. And if they're not overpriced and it's a good business, you're unlikely to get allocation. So both ways, it doesn't work out. If you look at, there was the last frenzy of these new age tech companies in 2021, around the same time, around November 2021. Most of them, let alone leaving aside the stock price also, most of them have not done that well on the business side. Many times the numbers peak just before the IPO. I mean, just giving a random example of Nykaa, I mean, all their peak numbers from margins to cash generation were at the IPO. At that time, the story was ki wait 3 to 5 years and you will see much better numbers. I mean, here we are 4 years later, the net profit margin has come down from 2.5% to 0.9%. And as I said, I'm just giving it as an example, not that it's the worst example, but I'm saying broadly, the company gets to peak numbers around the IPO, and often it is downhill from there. Lenskart, if you see the earnings, a lot of it is not even operating income. A lot
No,
of the earnings
we
are
we take that
further.
point entirely, Devina. And as journalists, we've been asking these questions of the management as well, whether they've left value on the table or not. What we want to understand is that now you've told us how institutional investors go ahead and put in money because of the investment bankers, that kind of relationship that they have to maintain, so to say, to get access to better IPOs going forward. But then there are these HNIs, and there are hallowed investors who are putting in money as well in the pre-IPO round. And amidst all of this, how is it that the retail, keeps its eyes and ears open and not get taken in by this FOMO sort of situation which is created? And this is not pertaining to just one IPO, but IPOs in general.
So FOMO is the worst reason why you should take any decision in the market, whether it is the IPO, whether it is the latest theme that did well, and maybe your friends are saying, I made so much money in this thing, whatever. I mean, if you go back over 2 years, there's been PSU, there's been small cap, there's been this, that, and you get in onto the bandwagon usually at the wrong time. So FOMO is not the reason. The other thing to remember is that there is only one way to value a stock or a company, whether it's an already listed company or to be listed company. If anyone is trying to tell you that look at these other type of valuation parameters, they are trying to justify a valuation. They're not doing a valuation. So remember all of this, that I remember in the 21 frenzy also an anchor asked me, Devina, gun to your head, which one will you buy? And I said, I won't buy any. So that's the point. And if you look at the performance of all those listings, they haven't done anywhere close to what the market has done. And some have not even, yeah.
But it's a good conversation and a very interesting one, Devina. Usually our conversations are centered around what to buy. Today we discussed sometimes what not to buy. That could be a great call as well when it comes to your investments in the market. Thank you so much. Good conversation. We look forward to many more. You have a great Friday.